Hey there, welcome to the show. Well, you know what? We've got a fun one planned for you today. Sometimes we have so much to talk about real estate, and I think we're going to have a lot of fun today because joining me in studio today, I have Brynn Lackie, and of course, you know Brynn from coming on the show. You also can catch her articles in the Toronto Sun. Some really good opinionated stuff. You don't want to miss out on that. And of course, she does work for Chestnut Park Realty as a realtor, and always kind of giving us the up to date on what's happening in the world of real estate. And I'm always remiss of telling you who Dave Butler truly is. So Dave is, just so you know, he's been the number one mortgage broker in Canada numerous years, and so he just doesn't come by his advice, kind of like tongue in cheek. He actually knows how to do this stuff. So guys, welcome to the show.
Thank you very much.
Thank you. When I found out Brynn was in studio, I'm like, hey, this is always not saying anything about Tim. We have the triangle with Tim, but I mean, it's a little different flavor. I like it when Brynn's in, and Brynn is a solid real estate agent, so it's always good afterwards to get tips from her and stuff like that.
Oh my goodness!
Well, look at that, Brynn, boy. Look at listen. If I know it's radio, but she's blushing.
I am purple.
Yeah. We both have red hair, so there's just that connection.
Well, that's it. Kindred spirits, right?
Blush or flush.
Yeah, and heck, just so my mom was a redhead, so
I knew there was a connection.
Yeah,
there was something there.
There we go. Yeah. Power to the Reds. Yeah. And it's funny, speaking of Reds and Canadian real estate, I gotta tell you, it's been kind of interesting. It's been both quiet, and it's also been kind of monumental because there's a lot of stuff hitting the fan as usual in the world of real estate. And it's interesting because here we are, basically coming through to the past the middle of November, and you got to start thinking to yourself, okay, so how's the year going to finish out? And for us, in doesn't matter what aspect you play in the real estate field, it's been a real minefield this year. Like nothing that anybody could have expected. Nobody could turn around and have the crystal ball out. As much as we do here on the show, try to predict what's going to happen. And Dave and I have a little side wager for the Bank of Canada for next year. We'll share it to you when it unfolds for sure. But that said, the interesting thing about the world of real estate is that it has now become more of a micro market analysis. Like, we used to sit here and talk about, once upon a time, we used to talk about things quarterly. And then, of course, markets started getting more aggressive. So then we started talking monthly, and then we started talking weekly, and then we talked daily. I think right now, the pulse of real estate is if a sale happens, you hear this little chime in a brokerage, and it's like ding, ding, ding. So it's almost momentarily. And Brynn, I'm going to touch on that because you did write an article that I did read, of course, and I was about to post a comment on it, and then I thought, hey, listen, why don't we just do it live? So you did talk about obviously the dishevelment of the real estate world and how we could be in kind of for some rough times.
Yes, I mean, I think we've been in the rough times.
Right.
In the same way that we didn't realize we hit the peak until it was over, I'm hoping that we start to realize that the rough times are really everywhere because they're receding. That's the optimistic view. It's an interesting time because I think there have been a lot of people who working in real estate are just trying to stay positive and trying to be upbeat. At the end of the day, it's very hard to escape the fact that we have, I think it was described as the roughest market in 25 years. I read something else that said we haven't seen a slower market since the early days of lockdown. That's certainly what I'm seeing. Now the metric for how you gauge a successful week in showings is, you might have a couple and you'll be happy. Whereas it used to be if you had fewer than 3 or 4 a day, you thought something might be up. Like, is this thing on? I think it's a lot of people who are trying to figure out what comes next and where to go. And I think it's also a lot of people who are just on pause waiting to see what happens.
It's interesting because if we do talk about numbers, and our volume's down, and we have, obviously this is definitely not going to be a stellar year when we finally took a look at the final sales. We're throwing out numbers probably about 70,000 transactions. Okay, that's going to be from, and we did see a bit of an uptick. Like in the spring, we did see, when everybody thought, oh, maybe, the market's going to, interest rates are going to pause or whatever, but we're going to be sitting at probably one of the lowest volumes we've seen in a decade. And that's okay, because, when we talk about the COVID years of 21, it was insane for 121,000 plus transactions in the GTA. So here's the big thing though. Yes, we hear people that are struggling. We know that for a fact when we talk about finances. But Brynn, when you take a look at the sales, forget about, if we could just stop talking about February 22, okay? Because that really is the measuring tape, right? This is what everybody's using. But unfortunately, that's not a true measuring tape to a lot of people that got into the market. So let's say you and I go back to February 21, right. Okay? Or for that matter, November 2020. When we take a look at those numbers, they're no different than they are today. It's just, we had this crazy rise. And then, so now it's how they move the measuring tape. And that's the one I struggle with, because again, I understand, people are struggling with interest rates. That's a given right now. We had a lot of people locked into variables and they were kind of monkeying around, and that's where the pressure point is. But when we talk about a collapse of a market, I can tell you, being part of the 80-90 debacle, that was, years of decline. We saw 30-40% retraction in price, and it wasn't because it was a peak. It was actually from a flat line that you watched the bottom come out. So it came out across months, where right now we're seeing the bottom come out across 2 months basically.
I think in all of the cases you're seeing, we have a tendency to want to contextualize. So when you're sitting here saying prices today, well, let's put this in perspective of the peak, or let's put this in perspective of, even when you're describing the market, there is a tendency to compare it to 89. So I think the need to contextualize in an attempt to help people understand what this means in relation to things that have come before and what's likely to happen again. History never repeats itself, but it rhymes. I think that's why you're seeing a lot of that. At the end of the day, though, unprecedented times remain. This probably isn't going to look like things in the past, because there's so many, it's a confluence of factors that we've never seen before.
Yep.
And I think we probably have enough factors going on that individually they would be impactful. Altogether, who knows? So when you compare it to the peak, I think that's, for the people who bought for themselves, and I work with buyers and sellers, for the people who bought for themselves through that COVID run up, the conversations we were having, it was about, okay, things are wild right now. And at least for me, are you buying to stay? If you're buying to stay and your plan is you're not going anywhere, and this was the conversation we have all the time, if you have any possibility of needing to make a move in the next 5 years, let's really think very clearly about what we're doing. Because if you can ride, we knew there was going to be something on the other side of, free
Just didn't
money.
know when and what.
Didn't know when, didn't know what, and we know that time, the macro, you zoom out a bit, and the bumps, you stop seeing them. In the short term, it can feel very impactful. So for those people, I think, they're going to feel this. There are a lot of people who are sitting there with 2%, 2.3 rates, and things are great. But and Dave, I'm sure you can speak to this, the conversations we were having when those people were putting pen to paper and offering at those rates were, this is going to be almost like a gift from heaven for a little bit. Your carrying costs are going to be lower, but you need to be thinking about the fact that in 3 years, 4 years, 5 years, whenever your term comes up for renewal, you better be planning for that. And this, just take the gift for what it is now. And then, but I think, not to drag this out, but I think there were a lot of people who didn't think that. And I think the people who you're seeing the fall from the peak for, the people who are speculating, the people who are investing, not the people who are buying to stay. So I think it's a tale of two markets.
Yeah, Dave?
Yeah, no, I agree. I echo everything Brynn says. I think, if we're looking at the next part of this cycle, and that's what we have to look at. We are in, this is not a fun part. This is not fun cycle, this part. And
No,
this is not a fun part of it. But I think, though, we have to, be realistic. And I think that I don't see much help coming in the next 6, 7, 8 months. I just don't. I mean, now certainly if the Bank of Canada makes its move a little bit earlier than they do, then great. But the reality is that we don't have a lot of relief coming. So it really now, in my opinion, it's just, you really need to get your finances and your financial house in order. If you haven't already done that, you know what I mean? You need to be doing that now. You need to be getting yourself prepared. You need to have an outlook for the next 6 to 8 months to make sure that you are set up to get through it. When eventually the Bank of Canada does start to lower rates, whenever that is, that relief will come. But until then, I just think it's super, super important that every Canadian, every client that I talk to, we're trying. It's a preservation game. It's like, look, we need to just get to the spot. We do believe these are abnormally high rates. I mean, some people may laugh. Well, you weren't around in this. No, I understand
when
where
houses were $185,000.
exactly right. Like I
Different.
understand, but I can also see the charts. And I mean, at the end of the day, I also can look at the different data that's out there, and you can sit here and say, look, I don't think our country is even going to get to 12, 13, 14% rates. That's just whatever happened back in the 80s, 90s, where to get to that, it's not the same. We're just not there, right? Government debt is a whole, the interest on the government debt is a whole other story. You might be spending more on that than our military. You know what I mean? So there's a lot of stuff going on, but the reality is that I just think Canadians, more important, my biggest message to everyone is let's get through the next 6 to 8 months, but relief is coming. It is coming, and we will get back. And as far as volume and real estate units go, we're going to get back there. It's just, this is the nasty part of this part of the cycle that we just need to mentally get through.
Yeah, and those are the kind of things, folks, that you need to be aware of, and hence the reason why we've got Brynn and Dave joining us, on a regular basis. Because when you take a look at the big picture, when you zoom out, if you take a look at real estate, and a lot of people sit there and say, real estate's not great investment. Well, do you know that every single peak historically has been surpassed throughout the entire real estate cycle of the world? So, when we think about the peak that we had in February 2022, and people say, well, prices will never get that high again. Want to bet? I can guarantee you that we will surpass that peak. Now, I can't tell you when, but it will happen. And that's only because every single peak is built on, because it's that peak and valley aspect of all real estate. And every single time you have one peak, it will be surpassed eventually. Could it be in the next 3, 5, 10 years? Well, tell you what, the only way you're ever going to find that out is always tuning into us every single week. And if not, you can join me on the Simple Podcast, because we're going to keep you up to date on it. Follow me at the Simple Investor 1, of course, on Instagram. And when we come back, I've got more with Dave and Brynn, so stay with us. We'll be right back after this. And welcome back. If you're just tuning in, my two panel guests this week, I've got Brynn Lackie joining me. You hear Brynn here all the time, and more importantly, you can catch her articles with the Toronto Sun. And if not, if you happen to be cruising around Toronto, you'll probably see a sold sign by Brynn. She is with Chestnut Park. And, if you've been thinking about mortgages, there's only one person's name that really should come to mind. That's Dave Butler. And of course, Dave has been recognized as the #1 mortgage broker in Canada numerous times. And of course, he's my go-to guy. And, it's funny, we've been just having a great conversation afterwards, kind of in between commercial breaks, because, hey, what else are we going to do, right? We're just going to sit here and have chit chat with everybody. And, it's interesting because we were talking about how real estate's looking right now. And, and the funny conversation, of course, and both Brynn and Dave, they know lots of realtors. And, I kind of jest where, you really shouldn't have bought that Mercedes if you're new into the business. It's the guys that have some experience that know to kind of pull back. And, and I'm not making fun of the part-time agents, which I normally like to do.
I was going to say, what's happening? We're not making fun of them.
Yeah, no, but, sometimes I like that, Brynn. You know that. I'm so...
No kicking one down.
Yeah, I'm kind of feeling bad. You got to go back to your full-time job. But that's not real estate. But here's the thing. The one thing everybody knows about me is that I have the utmost respect for people like yourself, Brynn and Dave. You guys do your craft full time, and you take a look and assess the situation. But the best part about my two guest folks is the fact that they don't do what they do just for money or a commission. It's not what they're driven for. I have watched both of you talk about your scenarios with clients, and you've walked away from a potential commission because it wasn't right for your client. And to me, that just exudes everything that both these industries need to be focused on. And unfortunately, we had a lot of, I would say, quick buck artists, pop into it. 2020, 21, everybody all of a sudden wanted to be either a mortgage specialist or they wanted to be a realtor, and they all came swinging in because it's like, hey, let's make some quick money. And it was about money. It wasn't about a career. It wasn't about doing the best for their clients. It wasn't about being the best educated, knowing the area. Brynn, when you first started coming on the show, you and I would shake our heads because there'd be somebody coming in selling a house, and you're like, where did they get that price? And do they not know what's around the corner? They knew nothing about the school area. They know nothing about the amenities. They just turn around. My friend called to sell the house and said, hey, listen, you want a listing? And when you're practicing realtor today, if somebody wants to sell their house, and it's a little tougher market to be in, you got to make sure you price it right. And right now, there are still people thinking it's 21 with some of these prices.
Well, the interesting thing is during that time, you didn't actually need to know how to price a house because what became common
The market
and
did it for
expected
it.
was you price low because you needed to produce multiple offers, and then the market took it to the top.
Yep.
So it was very hard to screw it up. And if you screwed it up, ew. But now I was at a listing presentation yesterday, and we're sitting there, and I'm saying, they're preparing to list in February. And I said, I can't tell you your price right now. I can tell you a range of that things are selling for. But given that, the best comparable is the most recent and the most similar, we don't have that because the transaction volume is so low. So it becomes, a little bit more alchemy where you're sitting there trying to really get really granular and figure it out. But in this meeting, I'm sitting there saying there are so many people right now who have time, so many colleagues in my industry, not in my brokerage. There are a lot of realtors who have time right now. So they're going out and they're pitching this business and they're naming these big prices because a lot of sellers are still hoping that there's a way they can hit that peak. And the easiest thing in the world to do right now is say, sure, no problem. And then you'll just ride the market down with them if you're looking for the business. And that's, to me, I'm not interested in doing that because it's excruciating to go that way. So it's an interesting time because it's very hard to price anything.
Well, it's kind of a bait and switch when
It's
you think about
100%.
it.
Yep.
And here's the other thing is the time frame for your listing contract. So, once upon a time, and this is just, over the last few years before obviously the downturn, would be the fact that, people would say, well, I'll take a 60-day listing, right? and now I can tell you historically, I was back in the day when, people would take 6-month listings. I mean, I remember when I first got into the business, people were taking 12-month listings. And, nowadays, fast forward into, more current market, 60 was like, people would say, well, what do you need a 60-day listing? Well, we kind of have a bare minimum that we have to have, for some of the brokerages. So 60-day listing would be it. And, you sell it in a week. So it was no point. But the point is now it's like, even realtors that, let's say, have been in the business for 10 years, now you got to realize that, look, try convincing a seller, hi, I need a 180-day listing. Yeah. And you need them to understand why you need it. Dave, this is one of the big things because you work both sides of the coin. Obviously, if you're working with, somebody that wants to go out and buy another house, or you're working with a seller because they are saying, well, Dave, we should be getting this much because we want to go buy something, I'm pretty sure that most of your stuff now is we're throwing in that new condition, which is an old condition called conditional on the sale of your property.
I've never seen it until this.
Yeah, I was gonna say, I remember there was I saw a bit of that in like 08, 09, but it didn't. There was no traction, but this we're starting to see. I'm actually seeing it quite a bit. I'm sure you are too.
I did not. Yeah. I had to go to the lawyer at Chestnut Park to be like, how do I write this?
Sorry, we're not laughing at you. We're laughing with you.
No, because you just didn't saw it. How many of your people, this is the question, how many people are you seeing that have bought before they've sold?
It's still happening, but honestly, this is crazy. Well, it's crazy though. When I see it, it's rare, but it's an inexperienced real estate agent.
That's
honestly,
what I was wondering.
it's not. It's like, and it's a group of. There seems to be, and it goes to actually to what we're talking about. Is that like a lot of the newer real estate agents that have come in, even 18, 19, because there wasn't like a big drawback at that point. You know what? They haven't experienced what it's like to list someone's home, pay the money, and not get it. Like if you were around, if the 20, 21, 22 for most of it era, you didn't even have, first of all, you didn't have to spend a lot of money, to market it. I mean, but there are obviously some that did, they would do it and it would fly fast. But they would never saw red on their, there was no losses.
They weren't just paying stagers every month.
Exactly. And I'm seeing that, hey, listen, there's a house right beside me where I live that was built by the builder and was listed at like some insane price at the time, which probably if he had finished the place 4 months earlier, he gets it, which is crazy. And and guess what? It's still sitting on the market today. And I've seen now 3 different real estate agent signs. And on the last one, I talked to someone who knows the realtor and I said, why is she taking this listing? And he goes, honestly, I know her. She just doesn't spend a lot of money on advertising and she always thinks and she doesn't mind coming in at the end and doing it. And it's interesting because there's becoming a market now for the realtor that will sit back and just wait and just wait and just wait. And then they just throw their sign on it. They may got a different clientele and maybe they get something, but it's interesting.
So here's the thing, right? In the real estate industry, there used to be an expression and it's probably going to come back again. It's called list to last, right? So if you're a listing agent, that means you've got advertising power. And that was the real, like back in the earlier days of real estate. And I'm not talking horse and buggy stuff. I'm talking when I did it. But when we take a look at it, it was one of the biggest things is that people said, hey, Todd, why did you become a listing agent? Well, easy. I got all the phone calls. But more importantly is like when you did sell a house, all of a sudden everybody said, well, if you want it sold, you got to call, and this was part of it. And, for a while there, as we went through the heyday of 18 24 months wasn't even a real big market, but it didn't really matter who you listed with to a certain extent, right? So the guys and gals that were actually like hardcore listing agents, it was harder for them to validate why you should go with them because basically, as Brynn had alluded to earlier, was the fact that it didn't take long to sell a house. It wasn't like if you put it on the MLS, it hit MLS.ca. You were sold. Yep. You didn't really have to be. But now, and going back to the part-timers, sorry, guys, you're just not going to have the chops to make it through a tough market like this because you need the ability to market homes. If you're going to sell anything today, you really have to focus on exposure. You really have to focus on customer service. You really have to give people a reason why you should be the listing agent. And why should you stay tuned? Because when we come back, I've got more. So stay with us. We'll be right back after this. And welcome back. If you're just tuning in, my guest right now, we've got the 2 panelists that love having them on. They love actually hanging together. And so I've got Brynn Lackie. And just so you know, Brynn is a professional realtor. She's with Chestnut Park. And of course, you'll catch her columns in the Toronto Sun. I've got Dave Butler. I call him mortgage broker extraordinaire. And so does the Canadian ranking system, top mortgage broker in Canada, numerous years. So that's pretty cool. So, not only do I believe that I have the ability with this show of bringing people together to be able to inform you on what's going on, but you know what I also like being able to do is kind of make introductions to people because the odd time, you just never know, we might be able to throw down a deal together. And here's the thing, just before we started the show, Brynn, brought up the fact that, interest rates, not really loving them. And guess what? My mortgage is coming due and I'm just not sure, what my husband and I want to do. And I started thinking to myself, well, maybe I need to bring on a guest that might know something about this, right?
That.
Wow.
And go imagine that across from each other, I have the perfect dynamic duo to talk about the renewal process, about what you should be doing, or at least what you should be thinking of doing. So Brynn meet Dave, Dave meet Brynn,
wow.
Brynn realtor, Dave mortgage, broker, and guys, have at it.
Thank you for the introduction, Todd. So nice to meet you, Dave.
Very nice to meet you. Well, there's a lot to talk about because guess what? There's not really a set answer here, right? If you and I talked 5 years ago and you come up to me and said, Dave, I got my renewal coming up, we're probably down, we're 5-year fixed, 5-year variable. That was, and for what, 15, 20 years, that's kind of been the topic, right? So now though, renewals, this is the thing.
A month ago, it would have been a different conversation.
And it's funny you say that because even what I was saying to Todd on a couple shows before, we're starting to see the variable rate come back,
This is the
right?
question.
And this is the new thing, because in a weird way, not a lot of people have really done the metrics on this. Again, Bank of Canada has only increased the variable in 2023 by 0.75%. However, fixed rates have actually gone up in some cases over 1.5%.
Look at the stats flying right out of you.
Like, look at that. Can you imagine?
I'm a nerd though. I'm
Guys,
a
you're hearing
mortgage
this in
nerd.
live time.
It's live. It's happening right here on the spot. Yeah. So here's the thing, Brynn. So, as you have access to, obviously lots of mortgage brokers. And Dave, I'm not going to sit there and say Brynn's going to sign with you here right on the spot, although that'd be really cool. But here's the truth. So, Brynn, kind of build out the scenario of what you guys are thinking.
Well, so this is something that we're talking about, and I always think it's interesting because so much of the stuff that I do, at least with my clients, is theoretical. I can empathize and I can put myself in their shoes, but ultimately, when it comes time, I go, So I've been sitting here, and we have a renewal, and up until now, I've thought, probably keeping some agility and doing maybe a 2-year, maybe, depending on what the numbers were looking like, a 3-year fixed.
Yep.
And then I read something on Twitter, of all places, saying that there's a move now. They're seeing a huge proportion of 5-year variable coming back. And I thought, hold on, is this something we should even be considering?
Well, here's the thing, right? I mean, you said a great word, agility. I mean, and our word that we use is flexibility, is very similar, right? The idea is it's all about what you believe. If I sit here and I say to myself and my family, and we have our mortgage renewal coming up, and we say, you know what? I think rates are going to stay high for a while, and I'm not sure they're going to come down. Then the reality that you've already answered the question. You should probably be getting into something medium to long term, right? 3, 4, 5 year, because there's a fear that rates may not come down and that they may go up. So it makes sense to then lock that in. But if we're sitting here and we're like, look, we just had a huge rate hike cycle. There is, a higher, it seems like, probability that we could see some rates come down in the near future. When? That's the thing we can never answer. So what do you do to kind of protect against that? Well, if I have a renewal coming up this year or coming up in the early part of next year, flexibility. So what's that going to be? You talked about, actually, you said a 2-year. That's something that's interesting. Even a 1-year. That's something that's actually very interesting. Imagine taking a 1-year right now. Bank of Canada finally starts lowering rates, let's say by second half of next year, maybe even earlier, but let's see, right? And all of a sudden, your renewal comes up in November, December. And guess what? You now, instead of taking that 5-year fix, locking that in, which maybe was a better rate than the 1 or 2 year at the time, but you took the 1 year, and then a year from now, you come up for renewal. And if there's better fixed rates, maybe the variable is a much better play for you at that time. And that leads into another thing why the variable is coming back is because of this lack of increase in the variable this year and the fixed rates flying up. It's now, because previous to that, and even you said in the summer, we would have talked, the variable wasn't even an option because numbers-wise, the fixed rates were actually that much better. But now you have the fixed rates actually to a level where some of them are, like the 1 year and the 2 year, are considerably larger rates than the variable. And people are saying, well, a variable allows me, and this is the kicker, you got to really always know this on the variable, you're not stuck. You can lock into the bank's best fixed rate at the time you ask to do it.
Is there a penalty when you do that?
0. So it's called conversion. So this is an actual thing you can convert. Now, people always say, well, I want to lock into my variable rate at the time. No, that's not how it works. You can't lock your variable. You can lock in from a variable to a fixed, right? But again, it's the rates at that time. So you want to, in a perfect world, if you're someone we're getting into this, and if this all plays true and the variable does start to come down over the next year and a half, 2 years, you have the ability to actually ride that rate down. With that will come a lower fixed rate. Very, very likely the bond yields will actually follow suit, or may even be the lead.
About that in a minute.
Yeah, and they'll be the lead. And then you now can go from your variable that's now lower, call your bank, say, what are the rates you're offering me to lock in? They'll give you a set of rates. You then contact your broker or your banker, go over those rates, make sure you're making the right decision. And now you've made yourself, I believe, and again, it's all based on a thesis, but if it plays out the way we're thinking, it was much better to take a 1 year or a variable or something short than to go take a 4 or 5 year rate, because people think you can just break your 4 or 5 year rate, fixed rate at any time. No, the penalty to break a 5-year fixed rate, $500,000, it could end up being 30 or 40 grand.
Especially if the rates start going down and you're at a higher rate, because they just start talking about the interest rate differential.
You hit it. Hit it.
Believe it or not, I listened to your podcast. So here's the thing.
Look at
So
experts everywhere.
Yeah, you have to think about, why would the bank want to give you a lower interest rate when they're already getting you locked in for a higher rate, right?
Yeah,
we saw last week bond yields started to drop.
Yep.
Or maybe it was 2 weeks ago, because I wrote about this last week. started to see bond yields drop. And then some of the, not the like big six banks, but other lenders started to drop their fixed rates. Big six didn't. And so I'm wondering, normally you see it correspond. Is there a reason why sort of the big six are holding? Is that because seasonality? Why is that?
Well, it's very interesting you say that. So there has always been, prior to 2020 and 2021 and the madness, there was always a seasonality. And I had always just kind of noticed that bigger banks don't, some of them actually will try to capture that business. But for the most part, most banks have an idea. And when you have a seasonality and you have lower volume coming up, some of them will just say, I'm not going to fight for the low volume. I'm going to fight hard. Like I'll get treasury involved. I'm willing to squeeze my margins when I'm fighting for big volume. But March. December, January, that's generally not been. Now again, people will say, well, but in 2020 and 2021, it was insane. Yeah, well, that was like, we can never compare that.
Never be the counter.
Ever.
No, yeah, we should use that.
Seasonality is so, like, I have seen it for years, decades, and I've just been like, this is how it's always been. And I look stupid talking to my staff when they're saying, like, we need a break in 2020, and I'm like, it's going to happen, and then it never happened, because the reality is that's how it always has been. And so to answer your question, generally speaking, the banks aren't going to fight, the big banks are not going to fight too hard over small volume months. With that said, usually one or two will jump in, you'll see that, and then they'll kind of capitalize on the others sleeping. But right now, I think what's really happening and why you're not seeing the fixed rates drop considerably with any of the big banks right now is because we need more data. I think they got in a bit of a pickle. Right. And we saw the yields come down in the beginning of the year when it looked like inflation. They're like, okay, we got this. We're going to get there. It's going to be here by this date. So you actually saw the yields working in the favor of going, okay, we think rates are going to start to get low. Bank Canada's going to have to move quick.
Woke up again.
But what happened in May, higher for longer. They realized, we got a bit of a problem, right? Got a bit of a spike. Higher for longer led to a massive spike, I believe, in the yields. Like they ran.
Well, and preceding that also was this bizarre spring market where you were seeing peak prices again.
Yep.
And I think that was optimism. You saw that in...
And the yields at the time were helping too. Yeah, a lot of people don't realize, because there was no variables being sold at the time. It's all just fixed rates, because at the time the fixed rates were actually kind of pricing in a different story than the Bank of Canada.
Fours at that point?
Because the yield actually was down to like almost like 2.6, 2.7 on the 5-year, which would, generally speaking, in a normal situation, get you into the low fours.
So in that case, probably wishful thinking, right? For most people. And and I wish this section was longer, but guess what? We will continue when we come back, of course, with Brynn and Dave, and we'll find out, does she sign on the bottom line right here, or is she going to have to think about it? That's it. We got it keyed in. And when we come back, we've got more. So stay with us. We'll be right back after this. And welcome back. If you're just tuning in, we're right in the middle of a negotiation on a mortgage renewal. So I got Brynn Lackie joining me, and Brynn, of course, she is a licensed realtor with Chestnut Park, writes some great articles in the Toronto Sun. And so right now, she is the person looking for a mortgage because she's got to renew hers. And in the other side, the conversation's being had with Dave Butler. Of course, I look at him as the mortgage guru, one of the top mortgage brokers in Canada, been ranked number one, actually. And so these are the kind of things that, just for fun, we want to throw into the negotiation so everybody knows who the players are. So going back and forth with Dave and Brynn, the overall effect is what we're trying to figure out is that if you, the consumer, are face down right now looking at a mortgage renewal, what do you do? And Dave, when you've been talking to Brynn, you started talking about, I think it's a lot of people have to do a gut check. I think a lot of people at this stage looking at the market, we've been told that the U.S. Fed's going to reduce rates next year. Bank of Canada is going to reduce rates right now. In potentially the summer. We know they all lie. So do we believe the lie, or do we sit there and say, well, you know what, maybe we need to check them up a little bit longer? And you were giving Brynn some great advice, saying, how do you feel about, a 1 year? How do you feel about variable? I think a lot of times it's got to be people's threshold that they can deal with. Yeah. I mean, listen, you have to assess your own risk tolerance, right? I mean, we're in a weird world where the 1 year is actually a higher rate than the 5 year. And I need to be really clear with everyone that's listening to this show is that that's not normal.
What's the spread between the two?
It depends on the time, but I mean, it's generally speaking, in the olden days, let's say you got a 5 year fixed at 3.99, you're probably going to see the 1 year fixed at 3.2. right? So there's definitely you get a bit of a spread there, and then it works its way up. So the 1 year is usually the cheapest, then the 2 year, then the 3 year, then you get the 4 year and the 5 year, and so on. And the 5 year always is that one that seems to be the most kind of discount. It seems always the bank's making the least off that one, but they want to capture you for all the other business. But the reality is right now we're in an odd spot. 1 year is actually higher. Right. So you could there's 5 year fixed rates out there around 5.5% these days. Right. You got a 1 year, some in the low sevens. So imagine the part that's hard on renewals is going, but wait, I'm going to have a cheaper payment. If I go with the 5 year, I'm going to have a better rate. The 1 year is actually higher and it's going to make my payment. And so this is the eternal struggle of the Canadian mortgage consumer that has a renewal coming up is, do I take a little bit of pain, a little bit extra pain in that 1 year or that flexibility compared to the 5 year, knowing that I might end up making this a better deal for my family overall and save myself money? Or do I, again, if my risk tolerance is just like, look, I want to know what my payments are. I don't want to mess around. I don't want to play market here. I just want to know everything. It's better for me that way than the 5 year. I mean, that's never going to change. I think though, strategically, we want to always look at where we are in the cycles. And to my point, and to your point that we've talked about before, flexibility, agility is, I think, the most important thing for Canadians now, but time is going to be the thing that really does show who's right on this.
So, Brynn, what are you going to do?
Well,
the audience are hanging on.
For everyone, I was just waiting to go get that cup of coffee. Well, it's kind of what you were saying, Todd, about how all of these predictions, we've kind of, they've been proven liars. I also think that things have evolved really quickly so that people have had to really pivot on what they, believe to be a certainty. And so it's just so hard to even, and it's funny, I now have extreme empathy for all of my clients who have gone through this, especially, and I now think back to during the run up when you were sitting there and prices are going way, 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 way high. People were stepping out of their comfort zone. Parents were stepping in. It seemed like, you'd be priced out forever, live in a cardboard box. And so these are all things at play. And knowing that things can change so quickly, you just sort of have to make the best decision with the information in front of you without banking on any sort of conjecture. And I think we're in this world where if I look at Twitter, there are a lot of people who tell me that we're looking at, there seem to be two camps. The people who are like, it's a cycle, it'll be fine, everything's going to be okay, just like batten down the hatches and ride it out, survive to 25,
and then
right?
And then the Bears.
And then the Bears. And then the Bears, if you think that your property value will stay intact for the next 5 years, they think you're just high on hopium. You're going to see I see people with actual economics degrees in commenting on everyone's thing saying, no, correct, expect a 30 to 50% correction. And I go, well, is that because nuclear winter is here? So if that's the case, then maybe. But it's very hard to know because there are opinions everywhere.
Yeah, and everybody has an opinion, just like they have anyways.
But it's interesting because Dave, you're actually having, in having this conversation, it's helpful just to realize that there is no one actual answer. And the funny part for me is I have a husband who has one perspective. He's a little more risk tolerant than I am, but I think, you need information to be able to put that together.
Yeah, and one of the things that I think that we need to look at, and is it a cycle? Well, we can turn around and look at all the economists we want, and a lot of them, I do reach out to some of them out there, and they do believe that we are in a true cycle. It's acting like a cycle, but I think what everybody has to have a really good grasp on is the fact that that free money that we experienced during COVID is not going to come back. Okay, like everybody just needs to know where the new baseline will be, right?
Yep.
And so I think, Dave, if you're going to counsel Brynn kind of on that final last thought, it's like, look, here's your baseline. This is where we're hoping to be in the next 2 or 3 years. So we can't use a number below this because it's just not realistic that it's ever going to get there. So when people start looking at the differential, that they got to realize, if anybody sits there and actually thinks that they're going to get a variable rate at 1.5 or 2%, in the next 5 years, guess what? That's just never going to happen.
Not writing it down.
No.
Yeah, we're just not going to get there. And I'm not saying that you think that. What I'm saying is just for our listeners, right? They think, oh yeah, but they'll come back to normal. Well, normal wasn't normal. Okay, that was just it was a bait and switch by the government. God bless them. No, but the fact is that it was a bait and switch. Okay, to be able to get them through an economic time that they had no idea what to do. And so now we sit here today and say, Dave, what is your best guess of what baseline will look like in our future?
Yeah, no, you're 100% right. I think what we need to make clear is the 1.99s, the 1.5s, the 2.5s, even maybe the 299s, I don't believe that's in our cards. I think we need to be playing for something that is at least in the cards with the bond yields. And when
I would
study,
love a 4 again.
well, there you go. So you know what? And Todd and I have actually we have this magic number, and we've been saying it since beginning almost spring of 2022. Is that if you get 3.99 back on a 5-year fixed, I really do believe that is a solid rate. You know, there for so many years there was 3.79, 3.89, 3.99, and we got a little greedy when things got in the twos. But the reality is when I started in this business, you know, and I'm not, and I've been doing this for only 2 decades. That's not, I'm not 80s, 90s. I am in the 2000s, and average rates, you know, 4.99, 4.5. Then we saw some changes after the dot-com bubble and everything else, and you started to see that 3.99 was an achievable rate. You only need the yield, and this is people got to understand this. You actually only need the 5-year bond yield in Canada to be at roughly 2.4 to 2.5 to get a 3.99 5-year fixed rate. Guess where we were at on the yield in April? 2.6. Now you have to understand, why wasn't there a 3.99 or a 4.29 at that time? Because there's risk premium being built into the fact that inflation was not fully under control. Once inflation is back under control and they feel like we're there, you only really need to prop up about 1.5% on top of the yield to figure out what your rate's going to be. So to get to your question, you got to go with the expectation level that in a perfect and your best case scenario, if you take a variable, is that you're probably going to end up maybe locking into at best 3.99, maybe something with a 4 in front of it. But is that better than taking a 5.5 or 5.79 5-year fixed rate and then not being able to get out of it without an extremely large penalty? And these are the questions. And to be fair, you're right. There is no right answer because this is something you have to go and talk with your family about.
And even your family can be on different pages.
Oh,
yes.
Yeah.
What I feel and what my husband feels. Like, I married someone who's got, you know, he's very happy with the gas light on and isn't worried. And now I let it get to 0. Like, I've inherited that. But I think it was interesting to hear, and I wasn't aware of this, that if I were in variable, we see rates come down, that you can convert that. Because to me, whenever, and maybe this is because I'm hearing so much chatter, anybody, you know, for a while there, the narrative was that any mortgage broker pushing you to variable was doing so because they were just trying to get the deal, they were trying to make the most money, they didn't care about you, blah, blah, blah. It's interesting to consider that right now it almost gives you a little bit of runway to get more information, especially if we're in that sort of frozen thing. So this will be interesting. I will have to put my head together with my husband, get him on the phone with Dave.
You're gonna have to come back to us on the decision. So that just prompts me that, hey, the next time we get together with Dave and Brynn, we'll get an update. Maybe Brynn will share with us what her conversation was with her husband, and if he actually did reach out to Dave. And you know what? That's all.
Him off the ledge.
That's it. That's all well and good. And speaking of well and good, hey guys, great having you here today. I really, really appreciate it, Brynn, you coming in. Dave, as usual, joining me here in studio. And like I said earlier, if you're not following us, do so. The Simple Investor One on Instagram. You're going to catch me on our new Simple podcast. It's a heck of a lot of fun. You don't want to miss out on that. And of course, we'll be back next Sunday as usual. I do want to thank my producer, Aiden, in the booth. You know, he's made it really simple for us just to have a chat this week. And most importantly, I want to thank you for making us the #1 real estate talk show. And hey, by the way, if you didn't know, I've been doing this for 10 years here on the station. It's been a heck of a ride. And of course, like I said, back next Sunday at noon. I'm your host, Todd C. Slater. You've been listening to Simply Real Estate right here on News Talk 1010 Toronto.